Inflation is much too high. We need to really see that if higher rates are required, then we won't hesitate to deliver them.
Even if we don't get close to the 2% target, it's very likely that we will have some kind of an economic slowdown well before we get to the desired inflation target.
With regard to the additional sanctions, we're always open to additional sanctions. And I've been in consultation.
I hate to guess the future. No one really knows the future. I've never seen anyone really guess it well. But if Ukraine gets worse, I would assume that Europe's going to go into recession.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris at the JP Morgan conference, and here's what's coming up on today's program. No 275. The Fed hikes 50 basis points, the biggest increase in over 20 years. But Jay Powell says a jumbo move is not on the cards. The Bank of England is up next. It's expected to raise rates to the highest in 13 years. And coming up this hour, we'll be speaking to JP Morgan's Mark Badriciani, Barclays' Christian Keller, and the former Prime Minister of Finland, Alexander Stubb. Now, first thing is first, so let's check in on the markets. It's all about the Fed, inflation, what that means to bonds, and the great rotation. So if we get the board up, we look at stocks in Europe overall, but also tech stocks specifically, and what's going on with some of the energy, of course, conundrum as well. Stocks climbing. Again, we have this investor relief after the Fed raised rates as expected, but they countered fears of these super-sized hikes. If you look at what it means for European stocks, they're about 1.3% higher. I'm looking at futures on the S&P 500 and the Nasdaq slipping a little bit, but not a huge amount, and then the dollar turning higher with Treasury yields. Again, market reaction could evolve as we get through the day. In Europe, one of the things we need to watch out for, so let's look at the European map, is, for example, German factory orders. They plummeted. Now, this really highlights the toll from the war. And you can see, despite these concerns in Germany, because of inflation, the proximity and the reliance on Russian oil and gas, you can still see gains across the board. So the Federal Reserve delivered its biggest rate hike increase in more than 2 decades. The chair, Jay Powell, says 2 more are queued up for the next 2 policy meetings. It was his pushback, though, on talk of a 75 basis point hike that really moved the markets.
Inflation is much too high. We need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. 75 basis point in an increase is not something the committee is actively considering. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. If that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. If higher rates are required, then we won't hesitate to deliver them.
Let's get into the key market drivers now with our markets editor, Christina Quito. Christina, good morning. The Fed reaction, the market verdict is that they were dovish. What's the strategy moving forward?
Well, friend, I think it's going to be an interesting communication strategy for Jay Powell moving forward, because in what world is a 50 basis point rate hike, which is the biggest in 2 decades, really dovish? It's only in these sort of market environments that we're living in at the moment. And so I think they're going to have to really re-emphasize that they are on top of inflation, or they're wanting to get on top of inflation, and they're very willing to do what it takes to curb that. And that while 75 basis points isn't currently on the table, that could, of course, change. And so I think the Fed really needs to wield its flexibility here and, again, re-emphasize that it will want to curb inflation moving forward, and enough to do it that markets will pay attention to that again.
Yeah, it's changed everything for bonds. Again, the market reaction could be short-lived. Bloomberg's markets editor, Christina Quito. Thanks so much for joining us. Now, we're also joined by Christian Keller, head of economics research at Barclays. Christian, is the Fed now in a very tricky situation because they've guided the market so much that everything will be priced in before they do anything, so we can never really have the kind of shock and awe type that we had 5-6 years ago?
I do think it's going to be a tricky communication policy for them going forward. I mean, yesterday, obviously, they took away the fear from the market about the 75 basis points. They confirmed they're moving in 50s. It seemed they're going to move in, 50 yesterday, another 250s at least. That confirmed, in a way, what markets had wanted, and therefore you saw this massive relief rally. But, I mean, don't forget, ultimately, they do need to slow the economy in order to deal with those inflation pressures. They have emphasized many times in the past, the labor market is red hot. You can't have the cake and eat it. If you want to slow inflation, you have to bring demand down. That is what monetary policy tightening is all about. And I think the market obviously staged a big rally now, but it's a question whether how long that can last, given that there is a realization that the economy needs to be slowed through monetary policy.
Yeah, do you think, Christian, the market is actually misinterpreting some of the things that we heard from the Fed because they were positioned so bearish? This is still a Fed that means business that will go forward in readjusting things.
I'm not sure whether it's a misinterpretation. As I said, or as you said, the market was positioned very bearish. And now, there was a fear that there could be potentially the indication for bigger moves than 50 basis points. Those were taken away. And we are now sitting very much where, what markets expected. I think that is what gave this relief to the market. But going forward now, I think, it's unlikely going to be smooth. It's going to be very volatile because each data point, each time there's a new remark by the Fed, I think is going to swing markets possibly. So it's going to be, I think, a very volatile environment.
Christian, of course, the Fed also said that it will allow the holdings of Treasury and mortgage-backed securities to be trimmed from June onwards. What kind of impact does that have on the rest of the world?
Yeah, the quantitative tightening, as it's called, has been, there's a lot of debate around it. And it's obviously not only the US, it's going to start in other places too. But obviously, what the Fed does is most important. And it comes much, much quicker than it did during the last cycle, when there was almost 2 years between the first hike and the quantitative tightening. And the pace, actually, they're going to be at their 95 billion level already in September. The U.S. Treasury market has reacted relatively, calmly to it, but it does seem that we are now in a trend where dollar liquidity will be withdrawn, and I think one consequence you're seeing at the moment is the dollar strength. It does mean that the dollar looks to be strengthening going forward, and that is something obviously that is of concern for emerging markets as well.
So how much stronger, Christian, can you expect the dollar to become from here?
Well, we are already at, I think, 20, if you look at the trade-weighted index, already at 20 years high or so. But, this is an extraordinary situation. If we see the Fed moving ahead, and I think it depends a lot on how the economic situation will evolve around the world. There's a high uncertainty. But right now, the U.S. looks like the safest place and, the economy that can best deal with the current situation, not only with regard to interest rates, but also with regard to the war in Ukraine. So, it's hard to say, but, it can move further from here. We've seen that despite the trade deficit, the dollar has moved stronger, and it's difficult to call an end to it at this point.
Christian, thanks so much. Christian Keller, their head of economics research at Barclays, joining us this morning. Now, we'll have plenty more, of course, on the markets and the Fed. Also coming up later on in the program, we speak to Alexander Stubb. He's a former Prime Minister of Finland. That's a conversation on NATO and, of course, the U.S. administration. If you have any questions, send your questions on IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris at the JP Morgan conference. Now, let's talk about banks, because we've had a few European banks reporting this morning, following a quarter marred, of course, by the Russian invasion of Ukraine. And that's had ripple effects as the subsequent packages of sanctions have targeted everything from finance to energy and forced everyone and anyone to reevaluate their Russia exposure. So let's get straight to it with our U.S. finance editor. He's Michael Moore. Michael, good morning. We've had results from SocGen, Crédit Agricole, Unicredit, and all of them, of course, have this exposure to Russia. What are they trying to do with it?
Sure. So we're seeing a bit of a difference here in that UniCredit is taking, the bulk of the hit tied to Russia this quarter, $2 billion between the provisions and the write-down of its Russia business. But they seem to be indicating that this is the major hit they'll face from this, even if they were to exit the country. So that's giving investors some reinsurance. And otherwise, they had pretty strong results. So you're seeing the shares higher today. Whereas SocGen has agreed to a deal to divest its Russia business. So they said, the actual impact of that won't come through its earnings until that deal is closed. So this quarter did not feature the type of hit that we saw at UniCredit. So a bit of a different story, but the same general theme of the Russia presence weighing on these banks.
So, Mike, how do things look actually going forward if the war continues for a protracted time? What's the exposure for some of these European banks?
Yeah, so I think you are seeing them boost their guidance for the loan loss provisions for the year, and that's largely tied to an assumption that the Russian economy is going to struggle under these sanctions, and there will be more defaults tied to Russian borrowers that these banks have went to. I think you saw so much in early March. You saw so much pain for the bank stocks. They dropped dramatically in anticipation of this. So as it's coming through, the moves are not nearly as dramatic. But, we are seeing European banks have collectively, announced several $1 billion of provisions and write-downs of these Russia businesses. So they do have a scale to them that is being a bit offset, though, because they have largely seized on the active markets, and the trading revenues were quite good. So that's provided a counterbalance.
Right. Okay. Mike, thanks so much. Michael Moore, there, our head of finance in Europe. We'll get more on that shortly. We also have a good conversation, of course, on what's going on in Paris. We're here at the JP Morgan Global Markets Conference, a conversation on the Fed, and, of course, some of the positioning that we'll see here with not only investors, but after the Fed hiking that 50 basis points. Coming up, Elon Musk, Cathie Wood criticized having passive investment in a Twitter thread. We'll talk about that a little bit later on in the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, an early edition. I'm Francine Lacqua here in Paris. Now we're joined by Mark Badruchani. He's JP Morgan's global head of sales and research here at the JP Morgan Global Markets Conference in Paris. And Mark, thank you so much for joining us. I have a million things to ask about because it's Fed day, it's investor, there's inflation. I mean, it feels some days like the world is coming to an end, and then other days it feels like the market is like on a great ride higher. I guess the truth is somewhere in the middle?
Absolutely. But first, welcome to Paris, Francine. I know you know the city well. We're glad to have here. We've resumed this conference after 3 years because of COVID. We have 400 people coming from all over Europe and the US. And I would say the mood, and you and I discussed it before, is a bit circumspect, if I may. Like, people are worried.
People are happy, first of all, to meet each other, but when you look around the world, they kind of don't really know what to invest in, I guess?
So I think people are looking at the market, and if you ask about the Fed, clearly, and I heard Marco on your panel earlier on, yes, it was dovish in the short term, but at the same time, if you looked at the prepared remark, it was hawkish. I think what you saw yesterday is some depositioning. You had our macro hedge fund guys were convinced that there was a possibility of a 75 basis point hike. I think commodities, I'm sure we'll talk about it, is something which is on everybody's mind. And what you saw yesterday is probably the Fed showing that they're in control of the situation. They know what they're doing, and if anything, that will reduce the volatility in the market. And if anything, get the market go a bit higher.
Was it a mistake, though, taking out 75 basis point hike off the table? It focuses the market, certainly. I mean, you could have pockets of correction.
But there are 100 ways of looking at it, and you speak to 10 people, you have 10 different explanations. I think it's a very challenging job that the Fed has and the ECB, and hats off. I think they've done a phenomenal job during the COVID crisis, and right now we're facing a new situation. We have more growth, we have more inflation, and we have to deal with it.
If you had to choose between inflation and growth, and this is what probably will come down to the central bank, I mean, how does the market look at this?
So it's funny, 2 weeks ago we had the IMF conference in DC. On the side of the IMF, we run that every spring and fall, and the US client base was very focused on inflation and wanted the Fed and the ECB to do more. The European client base and the IMF representative there were highlighting the issue of growth in Europe. And I think US and Europe are, yes, in a similar situation, but there are major differences. First, I think the US has full employment. You've seen a lot of the COVID dividends has paid off already. The US consumer is in a good place, and as Marco was saying earlier on, like it's good. Europe, Ukraine is hitting Europe more hardly. Okay, the reality of energy prices is something which is very serious in Europe, and I think you feel it in the mood here. It is something, and we did a polling this morning. It said in terms of top concerns for investors.
This is investors or chief executives?
Investors. So here we have a conference. We have, as I said, 400 investors from across Europe, mainly asset managers and hedge funds.
And the survey? Bearish or bullish?
No, so in a way, it's like I like to say there is a difference between what people think and what people do. So to give you an example, people are very bullish on commodities. And we drilled down on the question, I think 60% of the room thought that commodities was going to be the best performing asset class. But then if you drill down and you ask them which one, agriculture comes first. And I forgot the exact number, but let's say 47%. And then if you really ask them, how many of you are really investing in agriculture? Well, the reality is not so many. Unless you're a macro hedge fund and you can do pretty much what you want, if you're an asset manager, you have a mandate. You have to stick to your mandate. You have caps about how much you can allocate. So yes, commodities is definitely an area where people are very focused on. I think the credit market, if you start looking at high yield, high grade, we're starting to see non-traditional buyers dipping into the high grade market. Why? I think we had a lot of volatility. With rates going up, yeah, go ahead.
But Mark, no, I mean, what's interesting is that this difference, right, between what people think and what people do. Is it the mandates, or is it because they don't know how to trade it? Because actually, if you look at the war, it's either really, it ends really badly or it ends okay, and so that's very difficult to play on the markets.
Yeah, no, but it's not. It's often not binary, okay? In the sense, you believe that commodities prices are going to go up. There are different ways to play it. If you're a stock picker, you're going to probably go after stocks which have a commodity exposure. And this is where it's very, the word is unfortunately or fortunately complicated. You would think, okay, agriculture, that should be good for farmers. Well, if you're a farmer today, it's not great. Your fuel costs have gone up. All your fertilizers costs have gone up. Your labor costs has gone up. You're getting squeezed. Yes, you may sell. Yes, shipping. Yeah, you will sell your wheat at a higher price, but you need to get to that point. So I think it's when you start drilling, A, it's hard even if you have an overall view to put that view in place, and B, to your point, you have mandate constraints. If you're an asset management, maybe your limit is to put 5% of non-aligned investments in your fund.
So, Mark, how does this end? Because the other concern, of course, is that when you look at the timeline, and reducing energy dependency, even some of the commodity, getting things online, there's a mismatch. How ugly will the next 12 months be as we try and adapt and adjust?
So it is, and I was listening to Jamie that you interviewed yesterday. I think it's very hard to predict, and we're not betting people, but we live in a world where we have different types of clients. We have corporate clients, we have hedge fund clients, we have asset managers. Our job is to make sure that we are able to service them. So if you're corporate right now, what are your concerns? Your concerns are supply chain, labor costs, return to the office, believe it or not, it's still a concern, shipping, to your point, and inflation. Now, if you're a big food producer, inflation is probably less of an issue because the price of raw materials in your price are relatively a small portion. If you're a small producer, it has a big impact. A hedge fund on the other side, all they want is to find dislocation in the market. They probably love these environments with high volatility. Some of them have great performances, others are struggling a bit more. So, yeah.
It's different for different clients. I also want to go back to the working from home idea. So hold that thought, Mark, and we'll be with you very shortly. We'll be back after the break with Mark Bajiciani, JP Morgan's Global Head of Sales and Research. In the meantime, let's also check the markets because it is the day after the Fed, so all about the markets. And of course, the rally that we've seen. Stocks and bonds are actually rising overall. Again, the Fed tightening their bets on what they're expected, but because they took 75 basis point hikes off the table, they are interpreted as being dovish. Will it hold? We'll have more. This is Bloomberg. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris at JP Morgan Global Markets Conference. Now, still with us, Mark Bajiciani, JP Morgan's Global Head of Sales and Research here at the conference in Paris. It's buzzing. I mean, I can hear you just about because so many people are so happy to see each other. Of course, this conference had a 2-year hiatus. Mark, thank you for sticking with us. We were talking a bit before about the challenges that some of your clients and the chief executives tell you. How do they deal with working from home? Is it really a problem for them?
So I think everybody is struggling with it for a couple of reasons. On one hand, we've seen that working from home works. And we were able, and you could see how a number of our conferences were done online, etc. And it's true, unless you're manufacturing, it's true for every officer. On the other hand, people also notice, and you see it in this room, there is something that happens when you have people together. There are the drinks, of course, but there is the fact that you exchange, you get more ideas, you are able to have a culture. I think the people who are struggling the most are probably the tech companies because they were quite liberal in their work from home approach, but now they're realizing that they've lost connectivity with their employees. And for them, if you're a programmer working from home in California or wherever in the world, your loyalty to the company, your connectivity to the company is very low. So that's their challenge.
Mark, because they can do it elsewhere, they can work from home.
Because to resign or to find another job, you log out and that's it. You're working for a different company. You don't know. You don't have any connectivity with your firm.
Because Mark, I guess the other flip side to this is companies that want people back in the office, if they don't give their employees of a certain senior level that flexibility, would go look elsewhere. And so again, this is a hugely difficult decision to make as an employer.
It's funny. Like I was, we're in France. I was listening to a competitor channel this morning, and they were saying that just by mistake, of course. And then they were saying that 70% of the people who changed job in the past year regret it. And you wonder, okay, why do they regret it? And I think part of it is we've seen some catch up after COVID where people want to try something else and the mobility had reduced, so now they're moving. I think for companies in general, there are jobs that are perfectly suited to working from home. Other jobs, I can tell you on the trading floor, all our sales and trading folks, we've been back in the office day one because we need to be able to provide liquidity to our clients.
But Mark, what does that mean for inflation? So I know we're looking at wage pressures. Again, yes. Do you have to pay employees more to make sure that they feel valued in their jobs? And if you're a chief executive manufacturing, how difficult is it to pass on that cost to the consumer?
So yes and no. And you will realize it's amazing. Like the number one reason for people leaving their job is not liking their boss. You could pay them a lot of money. If they don't like their boss, they're leaving anyway, okay? I guess I like my boss. I've been here working for him for 12 years. But the point is, money is not everything. There needs to be wage inflation. And I remember Jamie on one of his interviews saying, well, CEOs shouldn't be crybaby about it because it's good. It's good for the economy. It's good for employees. It's good. Yes, it is challenging for companies. But we need to get used to an environment where we will have higher inflation. we will have higher wages and we might have higher rates. And guess what? That's not the end of the world. If anything, we could have a buzzing economy with all of that.
Mark, thank you so much for all of your insight. Mark Mabshani there, JP Morgan's Global Head of Sales and Research. Now, let's shift focus to the UK. The Bank of England expected to raise interest rates to the highest level in 13 years today. The central bank will also clarify how it plans to sell off some of its $1.1 trillion government bond holdings. Joining us now is Bloomberg's UK economy reporter Lizzie Burden, reporting outside the Bank of England. So, Lizzie, after the Fed hiked rates yesterday, what are we expecting from the BOE today?
Well, Francine, 50 basis points is still hawkish in the UK context. There may be one or two members of the Monetary Policy Committee who want to go for 50 basis points, but the market sees only a 15% chance that they'll be in the majority today. We're expecting the fourth back-to-back rate rise from the Bank of England, but Bloomberg Economics does see a vote split, and that reflects the difficult economic environment in the UK, arguably more difficult than other major economies. And that's because on the one hand, you've got inflation running at a new 30-year high. We're expecting the bank to raise its forecasts of peak inflation in the short term today. But on the other hand, officials aren't going to want to add to the weight of the war in Ukraine on demand. We've already had a raft of gloomy data since the last Bank of England decision, the PMIs, consumer confidence, retail sales. So we're expecting to land at 25 basis points, which would take the key rate to 1%, which would be the highest in 13 years. And it's the level at which the bank has said it will start to consider active sales of gilts.
Lizzie, thanks so much. Lizzie Burden there, Bloomberg's UK economy reporter outside the Bank of England. Now, Jamie Dimon says the Federal Reserve should have moved quicker to raise rates as inflation spiked. The JP Morgan chief executive told me that the central bank's actions leave only a 1 in 3 chance of a soft landing. Well, Dimon spoke to me ahead of the FOMC decision.
Very strong U.S. economy.
Yeah.
Consumers in great shape, lots of money, spending the money. Jobs are plentiful, wages are going up, though everything's distorted by inflation and all that, but those are good news, and businesses are in very good shape, and the Fed is going to have to raise rates and reverse QE. And they're going to, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. And I wish them the best.
Yeah.
We're a little late, but remember 2 years ago we had 15% unemployment and no vaccine. So I think people should take a deep breath, give them a chance, and I think they got to move. I think the sooner they move, the better. So yeah, they're going to be raising rates.
Deep breath, but what could go wrong? I mean, you talk about a strong U.S. consumer, strong business. You talked also about storm clouds. What are those storm clouds, and what's worst case scenario? Right?
Yeah, I hate the word unprecedented, but there's kind of fiscal and monetary induced unbelievable growth in the U.S., which was true around the world, though it's obviously slowing down in Europe. That's abnormal. We've never really quite had that before. We've never had QT before. So, you look at QE, that's one of the greatest experiments ever done. They're going to be writing books for 50 years on it, and we're going to have to reverse it. And that's a huge change in the flow of funds over time around bonds and rates and stuff like that. My own view is that rates will still have to go up from here. And then you've got Ukraine, which, I think is a potential, when you look at Ukraine, obviously the wishful thinking is we have a Fed-induced slowdown works. The world is fine, Ukraine resolves, but there's a chance that this goes on for years and that you completely rattle global energy markets, wheat markets, commodity markets, and and we need, as the Western world needs to be prepared for that and needs to take every action today to be prepared that can get really bad tomorrow. And when it gets really bad tomorrow, you don't have time.
So how do you handle that? What's your plan B if it does go all pear-shaped?
I like the fact that it will deal with it. That's life.
But how?
I like in my view, the most important thing is American growth, and that America, I call it this Marshall Plan for energy, that we do everything we can, and this doesn't violate climate change, it doesn't change anything about long-term objectives, but that we do everything we can to get oil and gas into the hands of Europeans so they don't freeze in the winter. And again, I'm not saying it's going to happen, but you have a couple of problems out there. The national energy stuff the global energy is precarious.
What's the role of Europe in this? Could Europe see a recession because of the energy prices?
Absolutely. Our economists would say that Europe has slowed down to 2% or something. But the problem with right now, and the economists would agree with me, we're looking at a static analysis, that if things stay the way they are. But you and I know for certain things don't stay the way they are. And my view is there's a very high chance that oil will go higher. It only takes 1 million to 2 million barrels off the market a day that can drive prices up $30 or $40. And so we should prepare for that today.
The JP Morgan boss, Jamie Dimon, there speaking to me a bit earlier. Now, coming up, former Finnish Prime Minister Alexander Stubb on the possibility of Finland joining NATO. That interview's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Chinese travel and spending plummeted over the National Labor Day holidays. The government's stringent COVID-0 restrictions and fears of infection kept people at home. Tourist spending over the 5-day vacation period was down 43% from 2021. The number of rail trips taken over the break fell by 80%. Now, US regulators have added to a broad list of Chinese companies that face delisting in the US. JD.com is among more than 80 firms put in the regulator's spotlight because of Beijing's refusal to allow access to financial audits. The US and China have been at odds over the disclosure policy for years, and the SEC is cracking down on firms that do not comply. A group of British oil traders who made $700 million in a few hours have failed to prevent regulators from obtaining their records. A judge in a London court ruled that bigger capital traders must hand over documents to the UK's Financial Conduct Authority. The FCA was asked to intervene on behalf of the US Commodity Futures Trading Commission, which is actually leading that investigation. The traders say they were simply following publicly available market signals. And Booking Holdings has reported revenue in the first quarter that was better than analyst estimates, benefiting from pent-up demand for leisure travel. Shares in the biggest online travel company in the US jumped in after-hours trade, as it also reported a record quarter for gross bookings. This as travel executives say they are expecting a surge in bookings this summer as customers do splurge on vacations. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, reports in Finnish media say Finland is expected to make its decision on whether to join NATO in the coming days. Helsinki has been reassessing its security policy in light of Russia's invasion of Ukraine. Membership of the alliance, of course, would shift the security balance of the Baltic region, with neighboring Sweden also considering NATO membership. Well, joining us now from the JP Morgan Global Markets Conference here in Paris is a former Prime Minister of Finland. He's Alexander Stubb. Thank you so much, Mr. Stubb, for joining us. As always, I mean, this is a very difficult decision to do now. Join NATO, antagonize Putin, stay out of NATO, and risk security.
Well, yes and no. I think it's a continuum of Finnish foreign and security policy, which started with EU membership in '95 and forging a strong partnership with NATO. You know, we're more NATO compatible than most NATO states. And the way in which we see it is very much a win-win for Finland, for Sweden, for the Baltic Sea region, and for NATO, because, you know, you're looking basically at an army with 900,000 reserves, 280,000 mobilized, over 60 F-18s, 64 F-35s, different types of defense mechanisms. So I think it's very much a win-win. And I think our president has put it well. He says Finnish NATO membership is not away from anyone. It is for us. And I think that's a good way of putting it.
But it's the interpretation of how Russia actually takes and Vladimir Putin that's key here. How will he take it? Is there a danger that actually this escalates?
Well, the answer is no. And you have to go back all the way to 1949. And remember when Norway, Iceland and Denmark, Nordic countries, joined NATO, the reaction of the Soviet Union at the time was very similar. Now, what do we expect in Finland? We expect 3 types of intimidations or action. One is hybrid, one is cyber, and then one is information. The information war is already going on. I mean, you know, you saw yesterday Astrid Lindgren, the author of Pippi Longstocking, or Kamprad, the father of IKEA, being called Nazis in Russia. When Zelensky was giving a speech at the Finnish parliament 3 weeks ago, the homepages of the Finnish foreign ministry and defense ministry were down. So this kind of stuff we'll be seeing.
this is what, intimidation? I mean, I guess we hear about the nuclear possibility, and I don't know whether we should think about it, how we should think about it. Like, you were in charge of a nation. How should we look at it?
Yeah, I mean, obviously you always have to prepare for the worst case scenario. But let's be frank here. Putin might be a lot of things, but he's not suicidal. So the even attempt to start playing with the nuclear option, I think it's pretty much out of the question. And to be honest, I think that Putin is right now quite engaged in the front in Ukraine. And to put it diplomatically, it's not exactly like Russia's military escapades are doing a great job. So we don't expect this to be escalated in a conventional way.
How do you expect the war in Ukraine to finish? Could this be a very protracted and difficult war, or could we have a resolution?
Well, I think we're into plus 60 days of this war now. And Finnish winter war with the Soviet Union lasted 105 days. I see this being a protracted, long conflict. There are a lot of different scenarios how it could end, but my guesstimate is that it will end in a similar type of a frozen conflict with which it already started. But it's too early to say.
China seems to be playing a key role. How should Western allies try and convince China to get on their side?
Yeah, I think China is oscillating between pivoting with Russia and pivoting with the West. With Russia, it's doing the normal thing. In other words, going in where power vacuums and necessities for investment and infrastructure are needed. With the West, it's very careful because it's really afraid of secondary sanctions. It understands that it's all about the Belt and Road Initiative, business in Europe, business in the United States. So it's not a comfortable bedfellow with Russia at all.
I mean, would they be neutral or lukewarm? And actually, can they stay in this position for much longer?
I think they will. And, all of this talk that we are creating a bipolar world with a liberal world order, an authoritarian world order with Russia and China on one side, I don't think that'll be the reality. It'll be much more complex. It'll be flexible alliances between the East and the West, between democracies and non-democracies.
What does it mean for the dependency, for example, on rare earths, some of the security? It'll be complex, but in 5 years, how will the world look different?
Yeah, it depends on where Russia is at that time. I think we're looking at a Russia which will be isolated, and I think the dependency, therefore, with China and the West is going to be even closer. And yes, you could argue that some of the things that were supposed to bring us together have usually been driving us apart, but the truth is that I think the path dependency right now on raw materials and others is so close. And China understands that you cannot have an authoritarian rule without results, and therefore it cannot withdraw itself and decouple itself from the West.
Should we have seen this coming, the Russian war on Ukraine? Is there something that the West could have done?
Well, yes and no. I see this as a sequence of wars. The first one was in 2008 in Georgia, where I mediated peace as foreign minister. Stakes were low, ceasefire 5 days. The second one was Crimea. Well, you couldn't really fight anyone. The third one now is Ukraine. I think this was a tactical and strategic blunder from Putin's side. He never expected the West to be so united as we have been in terms of sanctions, armaments, etc. But I do immediately add that we in the West have to understand that this is not about Russia versus the West. It is as much about the West versus the rest. The reaction of the rest of the world has actually been lukewarm, and we have to take that into consideration.
Should Europe have an all-out oil and gas embargo against
in the
Russia?
long run? And this is what I keep on saying.
Why the long run?
Oh, because you have to phase it out. You have to take it step by step for financial, military, strategic reasons. But I think the base case for business is the following. Think about a divided Europe. Russia on one side, 40 European countries on the other. Russia will be fully isolated, politically, economically, financially, sports, culture, transport, energy, and travel. And this will last 5 years, 10 years, 15 years, we don't know. But that is the base case that you have to think about. Therefore, first get rid of coal, now get rid of oil, and then phase out gas.
Thank you so much for joining us, Alexander Stubb there, the former Prime Minister of Finland, joining us today from the JP Morgan conference in Paris. Coming up, Binance secures regulatory approval from the French government. That's a boost for its expansion plans across Europe. So don't miss our interview with the Binance Chief Executive, CZ. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now, Binance, the world's largest cryptocurrency exchange by trading volume, has secured regulatory approval from the French government. It's the exchange's first major approval from a G7 country, and we spoke to the Binance chief executive, CZ, in the past hour.
Overall, when this heavy quantitative easing, I think by some reports that I read, like somewhere between 50 to 80% of the US dollars were in circulation were printed in the last 2 years. That's going to cause way more than 8% inflation. So given that, I think many people are realizing that cryptocurrencies, Bitcoin, BNB, and other cryptocurrencies with limited supply can be a very good asset for holding value. Or at least protecting against inflation. So we're seeing a lot of demand in that front, and there's many other benefits. But yeah, there's many other factors. But that's already a very strong incentive for people to get into crypto.
CZ, you keep on hinting at possible M&A, maybe buying industries or companies to then transform them into crypto lovers. Can you give us a clue? What are you thinking? What are you ready to buy right now?
We're ready to invest in any business, in any decent business, any strong business that has existing users, existing models, but then they can be helped with additional monetization models, funding models using Web3, blockchain, cryptocurrencies. Includes news sites, social media sites. I think Elon's going to bring Twitter into the Web3 world, and traditional gaming companies, e-commerce, even logistics, even real estate companies. So in those other industries, we would make investments. We'll just be a minority shareholder, and we're pretty silent and pretty passive. But we want to help them to integrate with the Web3 crypto blockchain world.
Can I just push you on that? Have you had any conversations with Elon Musk? Are you looking potentially at investing in Twitter?
So if there was any conversations, you would be covered by an NDA, would be my understanding. So I can't really talk about specific conversations with specific people without the public announcement coming out first.
Well, that was CZ, the Chief Executive Officer of Binance, speaking to us a short time ago. Now, this is what the markets are telling us. Of course, it's the day after the Fed, and we saw a nice little lift, a nice little rally when it comes to equity stocks across the world, but certainly here in Europe. This is on the back of the Fed actually taking off the possibility of that 75 basis point hike off the table. Stocks climbing again. There's investor relief that the Fed raised interest rates, but to tackle high inflation, they're not going to do these supersized hikes. I'm also looking at some of the tech stocks futures actually on the S&P 500 and Nasdaq slipping a touch, the dollar turning higher with Treasury yields. Now, Bloomberg Surveillance early edition continues in the next hour. Kriti Gupta, Kailey Leinz in New York, and Edwards will be in London. We'll have full market moves, and I'll have plenty more throughout the day right here from Paris at the JP Morgan Market Capital Conference. This is Bloomberg.
Inflation is much too high. We need to really see that if higher rates are required, then we won't hesitate to deliver them.
Biggest issue here is he's focused on inflation, and he's going to be more Volcker-esque in terms of inflation.
Going back to the 1930s, we have never been able to reduce inflation by more than 2.5 percentage points without inducing a recession.
It's not a hawkish Fed. I mean, they put themselves in a position where they had to do this. This is kind of a problem of their own making.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, May 5th. Our top stories today. U.S. stock futures dropped back after a strong post-Fed rally. The Federal Reserve hiked rates to fight inflation, but stocks initially rallied after the Fed chair eased fears over bigger policy moves. The Bank of England is set to raise rates to the highest level since the financial crisis. It will also lay out how it plans to unwind more than a decade of bond purchases. And Ukraine is accusing Russia of what it calls missile terrorism in a wide range of attacks across the country. We will discuss the war in an exclusive conversation with the former US Defense Secretary Leon Panetta. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta over in New York. Matt Miller is off today. And Kailey, the initial reaction to the Fed, clear to see, risk on for risk assets. But the recent movement in futures suggesting we ask questions how long that lasts for.
Yeah, exactly, because even if Jerome Powell took 75 basis points off the table for now, he also said they won't hesitate to hike more if the data tells them they need to. So that's something that the market has to consider. Now, in Asia, I would say you did see some following through of the rally here in the U.S. in the overnight session. The MSCI Asia Pacific Index as a whole was up about 0.4%. Japan was still closed for a holiday. China, though, opened back up. Didn't see a gain, though. It actually lagged behind the broader Asian markets a bit. Part of that is just ongoing concern around COVID-0. Even as you have state media reporting on pledges that Beijing is making to support the economy. One other drag on the Chinese market was one stock in particular, Hangzhou Hikvision. This is a surveillance company, fell 10% overnight on news that the U.S. is considering imposing new sanctions on the company, potentially the harshest of any Chinese company so far. In other asset classes, I would note that the Japanese yen is weaker once again against the U.S. dollar. We're trading in and around 129, 129.71 is where we are at the moment. And you're seeing some follow through in the bond market to a less hawkish than feared Federal Reserve. You definitely saw that evident in the short end in Australia, that two-year yield Kriti coming in nearly 18 basis points back down to 271.
Yeah, Kailey, you mentioned that risk-off tone that you might be seeing in futures this morning. Well, this is coming off the back of the biggest increase in the stock market, going all the way back to 1978 on Fed Day. So it's only natural that futures kind of take a little bit of a step back, pair some of those gains. That doesn't necessarily mean this is not going to turn around in a couple of minutes, or a couple of hours, I should say, as we get closer to the stock market open. Nevertheless, futures down about 0.7%. When you look at the rest of the cross-asset picture, though, not a ton of movement, especially in the yield space. Remember, we did see a lot of anticipation going into the Fed meeting. You are seeing just about 1 basis point a yield higher, 295 on the 10-year. Not that exciting, just given the context that we've been given. The question is, what drives it now that the FOMC decision is in the rearview mirror? Crude also about flat on the day, and Bitcoin down only about 0.8%. So once again, not a ton of moves outside of the future space, but the question is, does this all turn around as we see more and more investors reposition when the stock market opens, Anna?
Yeah, absolutely. And Kriti, we're still telling yesterday's story, really, when it comes to the European stock markets. And that is that strong rally that we saw on Wall Street post the Fed. And so we see that moving its way across the Atlantic into the European equity markets. And post-Fed, we see a rally here for European stocks, up by more than 1% on the French market and the German market in particular. It isn't just the post-Fed move, though. There's some earnings news in here as well. Let me show you what's going on with basic resource stocks. That is part of the maybe post-Fed environment. We see this is one of the best performing sectors this morning, up by 1.9%. Technology also doing well on the back of that Fed interpretation by markets. But we also see some positivity around earnings stories, and I'll get to that in just a moment. The pound is losing ground against the US dollar, down by 0.7%. We're working our way towards another interest rate hike from the Bank of England. That's the expectation in markets, at least, that we get that in a couple of hours' time. We'll get a report from our colleague Lizzie Burden outside the Bank of England in just a moment. This is the positive earnings story I was talking about. Shell up by just over 3%. Yes, we've got higher oil prices, and that is a feature of markets, or was certainly a feature of the markets yesterday. And so the markets may be still playing on that theme in the EU ban. But also we're seeing strong performance in the rearview mirror from Shell. A record quarterly earnings picture, and so that going some way to offset concerns for the sector around Russia. Airbus is up by 7.3% over in Paris. They're focusing on a ramp up in the pace of production of their A320s, and that has gone down very well with investors despite war in Europe and slowing growth in China. Quick reflection on what's going on in Russian assets. We have seen a bit of movement higher in some of the energy-related and commodity-related stocks over in Russia as a result of, well, the higher commodity prices of yesterday, but also some of the divisions we're seeing within Europe about that Russian oil ban. If Hungary were to try and stand in the way of a block on Russian oil, Kailey, then that is something that, of course, Russia will be paying attention to.
And, of course, we will look for any developments on that front Anna. As for what else we're looking forward to in the day ahead, OPEC Plus will be meeting virtually and is likely to ratify another small production increase. The UK also will be voting in local elections where the Conservative Party may lose hundreds of seats. And finally, as Anna mentioned, we will get that Bank of England rate decision. That's coming up at 7 a.m. New York time. Creedy.
Yeah, Kailey, let's get to the biggest news, though, from yesterday. The Federal Reserve delivered its biggest rate increase in more than 2 decades, and Chair Jerome Powell says 2 more are queued up for the next 2 policy meetings. But it was his pushback on talk of a 75 basis point hike that moved the markets.
75 basis point an increase is not something the committee is actively considering. There's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings.
Well, let's get more on the Fed here. Bloomberg's Danny Berger is covering the markets from London, and Michael McKee, our international economics and policy correspondent, joins from Washington. Danny, let's start with the post-Fed market moves here. Yesterday, the biggest rally on any Fed hike going back to 1978. Talk to us and walk us through that price action.
Yeah, I really like how Steve Englander over at Standard Chartered describes it, that this is a case where doing what's expected turns out to be dovish. And the reason we had a reaction as if it was a dovish thing, I mean, it wasn't really, it was a 50 basis point hike, is because macro hedge funds had been really short this treasury market going into the decision, assuming that perhaps we would have talk of a 75 basis point hike. That didn't play out, so you get this immense short covering where a 2-year yield drops by 14 basis points. The question for markets is this the end of hawkish surprises when it comes to the central bank? And with 200 basis points priced into the front end in terms of tightening this year, is this the peak in 2-year yields? Now, this 2-year yield fall combined with the stock market rally yesterday, that great superlative you said, Critty, really showed us the extent to which the reaction was one of easier financial conditions. And that's kind of the opposite of what the Fed wants to happen if they want to combat inflation. Of course, we wouldn't be doing our journalistic duty if we didn't throw some cold water on it. Slightly, some of this is coming back today, though that's not surprising given the extremeness of the move. But we have to remember we have yet to begin the balance sheet unwind. Also, if there's concerns about growth as we tighten, that certainly won't be good for risk assets, Kailey.
All right, Bloomberg's Danny Berger, thank you so much. Let's get over now to Michael McKee for more on the Fed's decision. So, Mike, as Danny said, you didn't see a tightening of financial conditions after this. Did the market get the message that Jerome Powell wanted it to?
Well, the market definitely got the message. We watched the bets on whether or not the Fed would do 75 at their June 15th meeting just evaporate as he talked. They've moved back down to 50 basis points, which is what Jay Powell says the Fed's going to do for the next couple of meetings. And so the market is repricing for where the Fed is. But again, to say it's dovish with a 50 basis point hike, the highest since 2000, that's an interesting way of looking at the world. The benchmark rate, Powell said, should be at about 2.5% by the end of the year. That's close to where they think neutral is, although he says they don't really know. Balance sheet reduction starts June 1st. They don't really know what that's going to do to rates either, but he thinks it may add 25 basis points over the course of a year. And here's the key line. Yes, Powell says, there may be some pain. Now, he thinks the U.S. economy is strong enough that the Fed can bring it into a soft landing, or as he said, a softish landing, but history is not on their side. You can see there every time the Fed is raising rates significantly, the U.S. economy has gone into recession, and you look at where inflation is now, and it is going to be a tough task for them to get ahead of it. And we'll see how, as the year goes on, the Fed whether they sound continually dovish or not.
Mike, let's throw things forward and think about something that the market will be quickly moving on to this week, and that is the U.S. jobs report due out tomorrow, of course. What do expectations look like post the Fed for where we go here? Of course, the tightness of the labor market will be key.
Yes, absolutely. And I think that this is going to be one of those interesting cases like the Fed where what is good looks bad, because we've had very strong job growth, and now it's expected to pull back a little bit to 380,000 for the month of April. The unemployment rate, though, would tick down to 3.5%. The participation rate ticks up. Average hourly earnings slow a little, but not too bad. So that's a strong report. But because the headline number is expected to be a little lower, it may be seen as not as good on Wall Street. It would be a suggestion that perhaps we're running out of workers.
Mike, thank you very much. Bloomberg's Mike McKee with us from Washington. Now, the spotlight in monetary policy terms moves to the Bank of England. Our UK economy reporter Lizzie Burden is reporting from outside the BOE, outside the central bank. And Lizzie, after the Fed hiked rates by 50 basis points yesterday, what are we now expecting from the BOE today? Of course, the BOE has been hiking for some time.
Yeah, Anna, 50 basis points is still hawkish in the UK context. There might be one or two members of the Monetary Policy Committee who want to go for 50 today, but markets expect they'll be in the minority. Bloomberg Economics does see a vote split, but that reflects the difficult times in the UK, the fine line the Bank of England has to tread. On the one hand, you've got inflation running at a new 30-year high, and only expected to rise. You could see the Bank of England increase its forecast for peak inflation today. On the other hand, officials aren't going to want to add to the weight of the war in Ukraine on demand. And you've had a raft of gloomy data since the last Bank of England decision. Consumer confidence, PMIs, retail sales. So we're expecting to land at 25 basis points, which would take the key rate to 1%. And that's the level that markets expect will prompt the Bank of England to at least consult on how to approach quantitative tightening actively.
Lizzie Burden reporting from outside the Bank of England. We thank you as always. Let's go from England to back here in the United States. Ukraine accusing Russia of using what it called missile terrorism across the country. Russia bombarded, railroad stations and other supply line targets throughout Ukraine. Russia's defense minister said that the West is, quote, stuffing Ukraine with weapons. This comes as the U.S. Congress could pass a Ukraine funding bill as soon as next week. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. Jack, what is the latest when it comes to the assistance, food or military, going to Ukraine right now?
Well, whether you want to say they're stuffing them full of weapons, there is a lot of support for sending more military aid as well as economic and humanitarian aid to Ukraine and beyond in this request. A lot of this is focused on Ukraine, but there's also broader money for the World Food Program because of the issues with wheat coming out of Ukraine. There's bipartisan support for this in Congress, and the latest we've heard is that, yes, this could happen as soon as next week. Senator Chuck Schumer, the majority leader, said that that's the goal. I just checked with Chris Coons, who's a key member for foreign aid funding. He said that still seems to be possible. The big challenge is a number of Democrats want to attach and go in one big go the Ukraine aid as well as COVID aid, both domestic and international needs. The COVID fight has been locked up with Republican pushback to the decision by the Biden administration to end that Title 42 immigration policy. So there's always the possibility that Congress will do what it does in terms of slowing down progress on one bipartisan priority by attaching a number of other more controversial issues. But yes, there's a lot of support and seemingly progress on the Ukraine bill. There's also a push to, there's a bill introduced yesterday with bipartisan support that would require U.S. officials to follow up and investigate any possible war crimes committed by Russia. And John Cornyn, the top Republican on that, said it's possible that will get folded into this funding bill. So that's an issue with a lot of bipartisan support.
All right, and we know those issues are pretty rare in Washington, D.C. Thank you so much to Jack Fitzpatrick of Bloomberg Government reporting for us this morning. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big gainer in the early hours trade is Albemarle. This is the biggest miner of lithium, which of course goes into electric vehicles. Really strong demand there has led to higher prices, and that in result is leading to a higher forecast for the company, and the shares reaping the reward of that this morning, up about 14% before the bell. Another stock that is moving on the back of earnings results is Sunrun. This is, of course, a solar energy company. Yes, it's facing higher input costs, but it's having success in passing those on to its customers because, yes, demand is pretty strong. That stock also is up about 8%. One final one to mention, moving to the downside, would be eBay. Of course, it benefited in a big way from the pandemic-era boom in online shopping, but that is decelerating and decelerating fast. Its forecast coming in much weaker than expected, and as a result, that stock is down about 7% before the bell, Anna.
Kailey, coming up on this program, we will be talking to the former U.S. Defense Secretary, Leon Panetta. He joins us next from the JP Morgan Capital Markets Conference in Paris. More on that conversation shortly. We will also talk markets, of course, the Fed decision with Sebastien Galy, Nordea Asset Management Senior Macro Strategist. Plus, we'll be speaking with Air France-KLM CEO Ben Smith about the return of travel this summer. This is Bloomberg.
I think the whole world learned something that we always knew, that national security is always the most important thing, but it kind of recedes in the background. We're all doing well. But now it's the most important thing. It should be the most important thing for the rest of our lives. So maybe we all learned that is a permanent state of affairs. The Cold War is back. The allies have to coalesce, and not just for military purposes, but for global economic, strategic investment purposes, so that we've got a safe world.
That was JP Morgan Chairman and CEO Jamie Dimon speaking to Bloomberg's Francine Lacqua in London yesterday. Francine is now in Paris at the JP Morgan Capital Markets Conference. She joins us for an exclusive interview with Leon Panetta, former U.S. Defense Secretary. Francine.
Yeah, good morning, Kailey. I'm delighted to be joined by Leon Panetta, not only former U.S. Defense Secretary, but also former CIA Director. So, sir, thank you so much. You have a huge, unique insight into how this war in Ukraine could end. What should be the strategy of the U.S. and allies now to get Putin either to the negotiating table or just to tell him to, stop? This has to stop.
You know, we're entering what I think is a very critical stage of the war. We've been through 3 stages. The first was Putin invading Ukraine and trying to take over the capital, and that failed. That phase 1 was a failed invasion. Phase 2 was siege warfare, a lot of destruction, a lot of killing of innocent men, women, and children. I think they were trying to break the will of the Ukrainian people. That failed as well. We're now in this 3rd phase. Russia has retreated from the capital, but they focused on Donbass. They're also engaged in a lot of artillery and missile strikes of different targets throughout Ukraine. I think right now we're in a stalemate between Ukraine and Russia. And the real issue is going to be, how long does that go on? It could go on for a period of time. The other option is that it can produce some kind of negotiated settlement, but a lot of that's up to Putin, and I don't see that happening. And the third is it could escalate. So we are in a very critical stage of this war.
Could escalation mean nuclear war? If Vladimir Putin feels boxed in and things are not going to plan, could he press the button?
I don't think there's any question that when you put a bully in a corner, you absolutely have no idea what is going to happen. And I think that's true for Putin. Putin is someone who understands force. He obviously is disappointed that his forces have not been able to achieve a quick victory here. I don't think he likes stalemate. And so the real issue is whether he resorts to either chemical or biological warfare or some kind of battlefield nuclear weapon, or invades a NATO country. All of that is possible. And that's why we are in a very tenuous and critical part of the Ukrainian war right now that could tell us whether or not this is going to be a war that will resolve itself, or it will escalate into a larger war.
What role can China play? And why have they not come out condemning the war?
I think China is very nervous about what they see happening with Russia and Ukraine. They've seen the fact that Russia has been unable to accomplish their mission, that Russia is now under some serious sanctions that are impacting on their economy. They've seen the unity of the United States and NATO coming together. They do not want to be a target of the same kind of sanctions. And so I think Xi right now is being very careful not to be viewed as taking sides. He'll provide some words, but I do not think he'll provide any direct assistance to Russia right now.
Mr. Panetta, it's Kailey in New York. You said a moment ago that Vladimir Putin understands force, and I'm wondering if it was a strategic mistake for the United States from the get-go to say we will not use force, we will not put boots on the ground. For U.S. policy in the future, should we be telling our adversaries what we are not willing to do?
Well, Putin has been reading weakness on the part of the United States and our allies for a period of time here. I think that's why he went into the Crimea. That's why he went into Syria. That's why he went into Libya, why he went into Georgia, and it's why he conducted a cyber attack against the United States during our election system. He never paid a price. And as a result, I think he felt empowered. And I think that was true going into the Ukraine. So the answer to your question is that we need to make very clear to Putin where the lines are and be very clear to him that he will pay a price for aggression. He's paying it now. That's the right message to send to Putin. And for that matter, it's the right message to send to China, to North Korea, and to Iran.
He's paying a price, and yet it hasn't changed his behavior, Mr. Panetta. There is still war raging in Ukraine. What should the U.S. do next, aside from giving aid to the Ukrainians?
I think the most important thing is for the United States and our allies to remain strongly unified. We've never seen the kind of unity in the past that we're seeing now between the United States and NATO. They are really unified. The sanctions are working because they are unified. They're providing weapons to the Ukrainians that they desperately need in order to confront the Russians. And I'm really happy that we are providing important weapon systems that they need right now. And thirdly, we're reinforcing our position in NATO so that if Putin even decides to go into Poland or another NATO country, it's pretty clear that we'll go to war as a result of Article 5 of the NATO agreement. So we're taking the right steps. The most important thing is we cannot allow that unity to come apart. We can't allow any kind of crack in that unity, because that's what Putin is looking for, and he'll take advantage of that. So we must remain strongly unified.
Is there a danger that we have two blocks in the world in 3-4 years, the pro-Russia and the anti-Russia, and that the world will be really split in half with China, India, Russia, and others on the other side?
I think what could happen and should happen is that what the United States has done with our NATO allies is exactly the right thing to do in confronting Russia. I think the United States and our allies in the Pacific ought to basically form the same kind of alliance in confronting China. We need to be able to make clear to China that if they become aggressive, they're going to pay a price as well. That's the best way you deal with China, is to show that we are serious about making them pay a price. And we ought to do that, frankly, in the Middle East in confronting Iran, and we ought to do that with regards to North Korea as well.
All right, Leon Panetta, former U.S. Defense Secretary, thank you so much for joining us, and thanks as well to Francine Lacqua in Paris at the J.P. Morgan Capital Markets Conference. Now, of course, Jerome Powell mentioned both Ukraine and China in his news conference yesterday, both risks, even as the Fed raised rates by 50 basis points. We'll discuss more about the Fed with Sebastien Galy, Nordea Asset Management Senior Macro Strategist, who will be joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. U.S. stock futures dropped back after a strong post-Fed rally. The Federal Reserve hiked rates to fight inflation, but stocks initially rallied after the Fed chair eased fears over bigger policy moves. The Bank of England is set to raise rates to the highest level since the financial crisis. It will also lay out how it plans to unwind more than a decade of bond purchases. The BOE may also unveil forecasts showing slower growth and rising inflation. And the Pentagon says Russian forces are bogged down, slowed by supply line and morale problems in the southern and eastern parts of Ukraine. U.S. officials also say that Russian missile strikes have been off target. I'm Anna Edwards in London with Kailey Leinz and Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, the US picture, we are seeing a pullback from those really strong rebound, post-Fed rebound levels that we saw in the US on Wall Street yesterday.
Yeah, Anna, and I mean, this was the biggest kind of rally you saw on a Fed hike day, going back all the way to 1978. So it's pretty normal to actually see this kind of pullback. But also keep in mind, before the Fed, Monday and Tuesday as well, we had a rally in the market, and that was non-traditional as well. Traditionally, it's a risk-off first 2 days, and then you kind of see a drop back on Fed day itself. So to see that in reverse, it kind of sets up the stage for futures to take a little bit of a pullback. However, if this turns around, Anna, you will actually see a fourth day of gains, which given the sell-off we've seen year to date would be pretty significant. Look cross-asset, though, there isn't a ton of selling conviction, which makes you think that perhaps futures could actually turn around. For example, the 10-year yield not doing a whole lot, 295 on the 10-year. You're also looking at crude, which is really just down marginally, down 0.1%. And even Bitcoin, which tends to see a 4% average move, one standard deviation move, at least, is only down about 1%. So once again, in a volatility-adjusted context, not a ton of action when it comes to what the markets are doing this morning.
Well, and Creedy, of course, you're seeing a rolling over, not just in S&P 500 futures, but NASDAQ 100 futures as well, underperforming actually big tech is. You're starting to see a reversal of some of the moves of yesterday. Of course, Apple enjoyed a really big gain in that rally yesterday. It was up about 4%. It's now giving back about 0.8% of that in pre-market trading. Microsoft also down around that much. And some pain for the chip makers as well. AMD, Intel, each down about 1.5%. So a lot of unwinding of the moves we saw yesterday. And I think the Fed's message rang clear yesterday, ringing maybe differently in the early hour session this morning. It'll be interesting to see how this one shakes out.
Yeah, and it is that story of yesterday that European markets are still reacting to. But add into that, Kailey, the earnings story here in Europe, because it is both things driving Europe today. Yes, we've got the post-Fed rally in tech stocks and in basic materials that is helping lift the mood here in Europe. But we're up by more than 1%, and some of that is earnings related. More on that in a second. I put in the pound here, 125.66. We've seen weakness in the pound heading towards the Bank of England rate decision. This is a bit a dollar story, of course, but it's also to do with the pound and where expectations now sit for a rate hike and just how hawkish or otherwise we will hear the language from the Bank of England being. And it'll be a big focus on the split in the vote. What will the breakdown be of the 9 policy makers? Who will vote for what? And that's going to be a big focus. These are the earnings stories that I was mentioning. Shell moving higher, up by 2.8%. If you're looking back at the last quarter, a record profit for this particular oil major, this energy giant. And even the fact that we saw negativity surrounding their Russian business, that was not enough to cloud what was a very strong quarter for the company. And so that stock up by, as I say, 2.8%. And Airbus, this is a giant of the French market, up by 7%. They're still planning, or they are speeding up the building of the A320s. And so as a result, that's seen as a really positive signal about the future of that business. We'll talk more aviation with Air France-KLM coming up a little bit later on in the program. A quick word on Russia. We were just hearing really interesting views from Leon Panetta, former defense secretary in the US, where he was talking about how it's really important that America's allies stay together. Well, are there signs of gaps on the strategy that Europe adopted or announced yesterday with regards to Russia and oil? That is being cited by some watching the Moscow market, because we do see a bit of a move higher in Moscow stocks, and some of that's commodity related. Some people attributing that to some of the sort of rank-breaking comments that we've had from the Hungarians around oil, Kailey.
All right, Anna, well, let's get back to our conversation around the Federal Reserve and the implications for these markets. Joining us now is Sebastien Galy, Senior Macro Strategist at Nordea Asset Management. Sebastien, the market clung to Jerome Powell yesterday, saying that they are not actively considering a 75 basis point hike. What I feel like the market didn't hear was him also saying that they won't hesitate to raise rates even further if it is necessary. Was that press conference yesterday as dovish as the market made it out to be?
I think it was quite a surprise because you're in a process where everybody's short duration and expecting yields to go higher, and trying to figure out both from the market point of view, from the economic point of view, and from the Fed point of view, how high can it go? Because the reality is none of them know it very well. The Fed probably has better models than pretty much everybody else. But even with its sophisticated model, quote unquote, they're not very sophisticated, it's actually very hard to figure it out. So what the Fed has done is essentially try to put a calming influence on the market to stabilize the rate curve. And by removing the 75 basis point, why do these people want? Maybe they believe in it, but they also believe that a recession will follow. And this is basically the trade that they're pushing, the view that they're pushing. And this is what the Fed is fighting again. Eventually, the Fed might have to hike more, but what it's doing is delaying the decision, because what it wants to do initially is try to calm the markets and say we are in control of the narrative and be in the front pages of Bloomberg as pointing out as such, and it's not really succeeding.
Right. I mean, would you think that the Fed would be happy with how the market interpreted the press conference yesterday, Sebastien? If the overwhelming impression, at least the short-term market pricing would suggest that the overall impression was a dovish one, would that be something that they were happy to let stand, or will we look for further Fed voices to come out and correct any misassumptions?
There are three elements. One is the relief rally that we've seen, short covering. There is blood on the market from the bears. That is a positive sign from the point of view of the Fed. The second element is that if you look at cryptocurrencies, they did not collapse. Gold did not collapse. Break-evens did not collapse. That does not indicate that households who are invested in the markets believe that inflation will come down very significantly and very rapidly. So this is a failure. The success is what we call swaption volatility. It's the volatility in the rates market, how uncertain are expectations regarding the Fed, and they have come down. So this is actually quite a success. So a mixed picture. And the problem that they have is if they go on the pages of New York Times, Bloomberg, and others, they're fighting against other stories which are more powerful, such as Ukraine and Roe versus Wade. And that is hitting their ability to influence your average CEO and households.
Sebastien, it's Creedy in New York. I want to stick with what you said about expectations, because Chairman Powell made a very strong comment yesterday that perhaps was kind of left in the background. Monetary policy is working through expectations to a large extent in this environment where a lot of the commentary simply says the market is far ahead of the Fed or the Fed is behind the curve. Is that by design?
What he's trying to tell us is that the Fed is able to tell us what the future is, because you should believe the Fed and not what you read from me or from somebody else. And they might actually be quite right, because consensus is relatively close to what the Fed is telling you. And the Fed has an enormous amount of economists and people working on these problems, both on the narratives, on the models, and on the decision process to drive these expectations. But it's pretty clear that your average CEO hasn't gotten the message yet, but they will. There's a beige book process. There are all these discussions they have with the Fed, where the Fed will have to convince them that inflation is not going to rise ever more, that wages don't have to increase ever more. And so this process is one piece of a strategy which is continuing to drive basically that long-term story. And behind that is your ability to figure out where neutral rate, that you will tend to, where is it? Is that 2.5, 2, or is it at 3%? And the answer is we don't really know, because what we
Well, he said it's more of a concept than an actual hard number figure, Sebastien. He also said that they could execute a soft or soft-ish landing. What exactly is a softish landing, and where do you put the odds around that?
The answer is, I'll give you the answer that you will not like, but the way that economists work is by assuming that there is a straight path. It might be somewhat uncertain, but there's a straight highway, and all you have to do is drive along it. It might go up and down a little bit, but it has a pretty decent trend in it. That's what we call the neutral rate. The reality, of course, is that you're driving down the mountain, it's night, you have your lights on, it's in the forest, there's some fog around, and you drive down to the plains and there are hills around, and eventually you reach home as the sun comes up. It's very complicated. These are a series of what we call temporary equilibria. Things can move very fast and find an equilibrium and then change it again. A lot of it depends on what the Fed tells us, or even sometimes some market commentators making outlandish claims. So we are in the process, which unfortunately is a complex one. So the answer is softish claim is driving your expectation. Do they know? They don't know any more than we do, but they probably know somewhat more because they're better trained, they're better at their models, and they're better at communication.
Very nice, very poetic, Sebastien. Thanks very much for joining us. Sebastien Galy of Nordea Asset Management with his thoughts on the markets. We will talk about the business of aviation and opening up for the summer post-pandemic. When do we get to those 2019 levels? We will talk to the France-KLM CEO, Ben Smith. Joins us shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today on Bloomberg, the CEO of Uber, Dara Khosrowshahi. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
We have this inventory and stock policy in place that gives us visibility, as I said, on the short and the mid-term. In parallel, we are activating secondary sources that will be ready in case we have to rely on non-Russian titanium exclusively. That's not the situation of the industry at the moment, but that's something we are looking at for the future, and we want to be able to continue to operate would we find ourselves in that situation. We have taken the decision to develop the secondary sources to be able to, at a later stage, potentially be independent from Russian titanium.
That was the Airbus CEO Guillaume Fauré speaking with Bloomberg's Guy Johnson yesterday. Now, staying in the aviation industry, Air France-KLM expects surging demand for travel to drive a return to profitability this summer. That's as the airline group looks to repay government support received during the COVID-19 pandemic. Joining us now, Ben Smith, Air France-KLM's CEO. Ben, very nice to have you with us. Clearly, an aviation industry that is really excited, perhaps, by what lies ahead for the summer. What percentage of your 2019 capacity do you expect to operate this summer, Ben? Are we going to get back to 2019 levels or stick around 90%?
We're looking at between 85 and 90%, and over 100% on the transatlantic, our biggest and strongest market. So we're quite excited about the transatlantic.
And if there were to be one thing that might stand in the way of a successful summer, would that be higher oil prices, a shortage of cabin crew? What is the big risk to that strong summer?
Well, you mentioned those. I mean, the higher fuel prices are a concern, but even with the higher fuel prices that are already in place and the increased pricing that we put into the market, the demand is still very strong. So we're quite encouraged. The fact that restrictions are much lower than they were in the past, the ones associated with COVID, are really helping us. Because right now, if you're living in France, as an example, and you want to go to the U.S., there's no test required on the way back, so you don't have that worry that you'll get stuck in the U.S. And coming back to France, and that's really helped us.
So the flow of people around the world due to alleviations in restrictive COVID measures is easing. The flow of supplies of things like commodities isn't necessarily. You were talking about the impact that higher fuel prices has on your business. That also has an impact on consumers that are facing higher prices at the pump, at the grocery store, on their energy bills. At what point do you think there is a risk of the higher costs on staples, necessary items that consumers have to pay will weigh on discretionary spending, things like airline tickets?
Well, we think, at least right now, because it's been so difficult to fly over the last 2.5 years, depending on where you live, that the traveling has moved up in terms of the rankings of non-discretionary or discretionary spend. So we're not seeing that yet. 9 months from now, a year from now, perhaps that may change. But for this summer, we are really seeing strong demand. It's quite encouraging. We're really pleased. Our U.S. competitors, domestic U.S., they've been enjoying this for quite some time. We don't have the equivalent here in France or in the Netherlands, so we have not been able to have an equivalent improvement in our performance. Now that international long haul has come back, in particular transatlantic, as I said, our biggest market, we're going to actually have more capacity on the transatlantic than we did before. There will be flat capacity in the industry. We are seeing higher yields, and I think what is a great phenomenon, we're only at 70% in terms of business traffic return, but we are seeing a new phenomenon, which is what we call high-end leisure. And this is making up a big portion of the lower traffic that we see in the premium cabins. It really is amazing. France is the #1 inbound market in the world. And as you know, it's strong leisure and there's a heavy luxury component to it. And we're quite well positioned to fully leverage that.
Ben, it's Creedy in New York. Let's talk for a moment about government aid. Will Air France-KLM need Dutch state support? And how does it plan on repaying, or when does it plan on repaying the French state aid?
Well, we've got a good plan to repay both the Dutch state and the French state from the destabilizing loans that were put in place. We've already started paying back both governments. We are working on a number of projects to improve our equity position. We're hoping to close on a few of those in the near term, and we'll be very happy to expand on that and to announce those when they're ready.
How difficult is it to find, Ben, staff at this point? Are you struggling to make sure that you've got all the staff that you need in the places you need them to facilitate what looks like an exciting summer?
So I think unlike the U.S., where there is a really strong pilot shortage, because in the United States, the airlines require pilots to have a minimum of 1,500 hours. There is not that same rule in Europe. So we do not have a pilot shortage at Air France-KLM. No pilot shortage, so we have no problem from a pilot perspective in operating our fleet. On the cabin crew side, there's no issue there. We are having some challenges on the airport staff, and particularly on the ramp. But passenger services in the airport, not an issue, and maintenance, not an issue. So we've got some challenges on the airport ramp side. I think we'll be able to handle them. We've got to ramp up. I don't think anyone was expecting this kind of a return so quickly. And this is we don't need to put these people through massive amounts of training. It's just we need to find the people at those to fill those particular jobs. And because there is such pressure on U.S. airlines to have the necessary staff to operate their schedules, that's good news for us.
Just finally, Ben, a quick word on fuel prices. How well positioned are you for fuel prices if we do see substantial moves higher from here?
Well, I think relative to many of our competitors, we are better hedged. So European competitors are about the same, but we look at competitors in the U.S. and other markets. I think we're better protected. On the short and medium haul, we've got big differences. We have some airlines that are 100% hedged. We have others that are zero. So I think what we try to do is have a balance so that we are overall not put in a relatively worse position. So look, it's never great in our industry to have fuel prices that go up. But I think what's different this time, the lag should be shorter. Our customers are booking much closer in, so our ability to increase prices and ensure that they have the right impact on our bottom line is much better than it would have been, say, a few years ago.
Ben, thank you very much. Ben Smith, the Air France-KLM CEO, speaking to us as the company reports its numbers. Coming up on the programme, more on travel, in fact, later in the day. The Expedia CEO, Peter Kern, that's at 5:30 p.m. in New York, 10:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Tom Keene, who led our historic Fed coverage yesterday, joins us now with the single best chart. Tom.
The single best chart, Kriti, is really simple, and this goes off of the move when we saw 75 beeps dismissed. And then the neutrality question came up right after, and the market took off like a rocket. But I really think we need to put it in perspective. This is Standard & Poor's 500 across the deviation model. This is a very sophisticated chart. I'm not going to go into the details too early in the morning. But all you need to know, Kriti, is we bounced off the bottom in a very big way and didn't get back to the center tendency of the new volatility and also to the long-term moving average, which is an exponential moving average. The answer is we just bounced off the bottom and sort of kind of like got back to the mean.
sort of kind of like, all right, Fed day behind us, Tom. Jobs day is in front of us. Who are you going to talk about it with on your program today?
I'm glad you bring that up because the jobs day is extra important now after what we saw on the Fed meeting, 3.5% unemployment. And of course, jobs, labor, the fully employed America came up numerous times in our conversation yesterday. Thank you, David Blanchflower, for heated conversation from Dartmouth. Andrew Sheets will join us really to sum it all together. We're really looking forward to Mr. Sheets joining from Morgan Stanley. And also, Winnie Scissor will join us, some credit insights, too, on the bond market reaction.
Looking forward to it. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. In addition to looking forward to that, here's what else we will be watching today. I will be watching the OPEC Plus virtual meeting. Will they change course? The answer is probably not. They're probably just going to go ahead with that 400,000 barrels or so a day hike, even amid the news of the EU potentially looking at an embargo of Russian crude happening over the rest of the year. And Creedy, obviously, OPEC Plus really hasn't been having heated discussions about this really in the last couple of months. The meeting has been very short, even despite political pressure. I wonder if it'll be longer than, say, 13 minutes today?
Well, we'll have to see. And one of the really reasons for that is simply the hangover that you're seeing from the pandemic legacy. And speaking of hangovers, what I'll be watching is the hangover from the Fed yesterday, specifically what the market reaction is, just given we've already seen that monstrous rally yesterday on the back of the Fed decision, as well as those two prior days as well. How much optimism is really baked into the market, Anna?
And there's a lot going on here in the UK. As you point out, local elections take place. That means 7,000 council seats or local government seats are up for grabs across London, Scotland, Wales. Reporting restrictions mean we can't say much about that, but we can tell you that the Bank of England is also meeting to set interest rates. Will we see the fourth back-to-back hike coming through from the Bank of England, from Threadneedle Street? That is going to be a key focus. And watch the vote split. Could we see a three-way split with some voting for 25 basis points increase, some for 50, and some voting to stay unchanged? That's going to be something that could move the pound weaker as we approach that meeting. That is it for the early edition. Surveillance is ahead. This is Bloomberg.